Welcome to today's video where we'll dive into a fundamental concept in the world of finance, risk on, risk off, often referred to as RORO. Whether you're an experienced trader or new to the financial markets, understanding RORO is essential for making informed decisions. So let's get started. First, let's delve into the concept of risk on and risk off. The definition of risk on, risk off, RORO, is that it's an investment setting in which price behavior responds to and is driven by changes in investor risk tolerance. Put simply, when global economic patterns are favorable, traders are likely to be more risk-on and invest in higher-risk assets to maximize their returns. They are confident in the economy's outlook and tend to invest in assets like AUD, NZD, which are high-yielding currencies. However, when markets tumble, traders will seek safety and invest in risk-off assets. They are concerned about economic uncertainties or potential downturns, leading them to shift their investments towards safer assets like government bonds, gold, or the Japanese yen. Besides, here is the key to help you understand risk on, risk off. Risk on, investors take higher risks in pursuit of higher returns in favorable economic conditions. Risk off, investors avoid higher risks and prioritize preserving their capital in unfavorable economic conditions. Then, there is a question to test if you have understand it or not. Is investing heavily in emerging market equities and commodities during a period of global economic stability and positive sentiment considered risk on or risk off? Tell me your answer on the comment of this video, and the answer is risk on. Then, let's talk about the importance of RORO in financial market. RORO is like a compass for investors. It provides insights into how global events and economic data impact investment decisions. When risk-on sentiment dominates, equity markets tend to rise and riskier assets flourish. Conversely, during risk-off periods, safer assets become more attractive due to the fear of potential losses in riskier investments. The next part is about risk sentiment. Risk is a natural part of investing. Whether the investment is in forex, stocks, bonds, commodities, there will be some level of risk associated with it. Understanding risk will help you when looking at risk-off versus risk-on strategies. Risk sentiment is used to describe how financial market participants are behaving and feeling. What traders choose to buy or sell means balancing how much they are prepared to lose with how much they expect to earn. Traders can often find signs of changing sentiment through corporate earnings. For example, a company's forecast being downbeat and pointing to less growth in the upcoming quarter could be a sign of changing sentiment. Traders can also look for signs in macroeconomic data. For example, how central banks are responding to rising or low inflation could be a sign of changing sentiment. You can look at risk sentiment as the expression of traders' and investors' willingness to take on risk. Think of risk sentiment as the mood of the overall financial market. Then we come to the last part, how to use risk on and risk off. To effectively leverage the concepts of risk on and risk off, it's crucial to ascertain whether the market is currently in a risk on or risk off mode. Once you comprehend this, it will enable you to align your trades and ensure that you are trading in harmony with the prevailing risk sentiment rather than working against it. In this way, you need to determine whether today is a risk-on day or a risk-off day, firstly. A risk-on day refers to a specific day or trading session in the financial markets when sentiment is more optimistic and the appetite for risk is higher. This positive sentiment is often driven by factors such as encouraging economic data, strong corporate earnings, stable political conditions, or accommodative monetary policies. A risk-off day refers to a specific day or trading session in the financial markets when sentiment is more cautious and the appetite for risk is lower. This negative sentiment is often driven by factors such as negative economic news, disappointing corporate earnings, geopolitical tensions, or other market uncertainties. After distinguishing whether it's a day characterized by risk-on or risk-off, you can align your trades with prevailing market sentiment to maximize potential gains. Risk-on, risk-off sentiment is the heartbeat of financial markets. Recognizing these shifts can empower you to make informed decisions that align with the prevailing market sentiment. Remember, diversification remains key. regardless of the sentiment. Stay updated, keep a watchful eye on global events, and adjust your portfolio accordingly. Thanks for watching. If you liked this video, be sure to hit that subscribe button and turn on notifications so you never miss a video.